Hey everyone, welcome back to another episode of AWM Insights. We're going to talk fads today, really going from hype to developing habits to really build real wealth, real multi-generational wealth. We're in this period of what's being thrown around as the new attention economy, and that's driving a lot of fads back to the forefront, I would say. And so we're going to go through what's making them so tempting, why they might work in the short term, but generally speaking, why it's not a repeatable, robust way to really maintain that long-term multi-generational wealth. The downside usually wins out or washes out, you could say. So we're going to jump right into it. Let's kind of define what we're talking about. A fad is something that it realizes really short-term momentum-driven gains, probably something that's not super
strong in fundamentals. It's strong in maybe a short-term narrative and excitement in marketing and branding. But when you just go beneath the surface, you're often left looking, asking more questions and wondering what's actually going on here. And so we're going to talk about some current and historical fads that have been driving a lot of attention, a lot of short-term wealth creation, and then kind of punchline here is a lot of loss of wealth as well on the back end.
Yeah, and we've seen so many different examples, starting off with the dot-com bubble, where the NASDAQ appreciated 800% over a 5-year period of time, which is crazy. And kind of when people started realizing that there were no fundamentals to back pets.com and these multi-billion-dollar businesses that were just a name, or kind of, as you alluded to, were just there to get attention and not dollars. You saw an unwinding of those markets and a pretty big drop off. So I think that fundamental piece really carries itself out to all of these examples. Go to cannabis stocks next, because those were getting really hot, especially around COVID time. There was legalization in Canada, legalization kind of in new states in the US. We saw a lot of deals on the public and private side.
Yeah, certainly on the private side.
Tons of deals on the private side. And I would bet, if I were to go back and look at those companies, not a lot of them actually survived, because there was this green rush, a ton of capital moving into these markets super quickly before anything was really established. And yeah, you've seen, at least in the public market side, some of these stocks are down 90% since their peaks. And unless something miraculous happens, you are not getting that money back. That is gone for forever, potentially. So yeah, it's really just a warning.
I mean, there's plenty more examples, and we'll probably weave some into the conversation here. I want to go back to the NASDAQ example, because I think that's incredibly important. It's arguably a diversified index, so that, NASDAQ or NASDAQ 100, very similar, driven by kind of a small number of stocks when you look into it. That took almost 15 years to recover. Now, it's a great reminder. Reason why I want to go back to it is because the NASDAQ market or NASDAQ index gets a lot of attention in the present day because it's done so well. And we are long-term investors. You all are long-term investors. So it's good to take that step back and say, oh yeah, well, it's done exceptionally well over a, generally speaking, long period of time, 10, 15 years, probably. You could sit 15 years. But if you started investing in NASDAQ at the bottom, 2002, let alone at the peak in 2000, right? Your returns look a lot different. And so this is a long-term game. And not only are we talking about chasing hype over very short periods of time, but even looking at markets over arguably a long period of time, 10, 15 years, like we're talking about the NASDAQ right now, you can be led to different conclusions and to really believe or ask yourself the question of, this time is different, which is a big mindset, or a common mindset that people get into around, hey, this is why fads work, right? You're convincing yourself of this time is different, amongst many other things.
Yeah, and especially with the dot-com bubble, I think something that we see in the data that we're presenting in the mainstream media is a lot of people just start looking at returns starting in the year 2000. And there's a lot of history and a lot of data that we have prior to that. So even the way that you slice and dice the data can really mislead you on how an asset class has performed, how tech has performed over, a longer period of time than just the past 25 years.
Yeah, totally. So there's some data mining, let's call it, that lead people to chase hype, chase fads. What else contributes to it in this attention economy, as they said?
A lot of it's emotional. Like, it's great to get excited. I get excited when asset classes roar and when there's optimism in markets. And unfortunately, also with excitement comes some certain degree of FOMO. Like, you see money being made, you see people doing well, and you want to participate, you want to be a part of that. And it really, unfortunately, comes down to, when are you hearing about this? If you're hearing about this when your normal, barista is talking about, if you're getting into Bitcoin, when hearing about hearing about it from your 70-year-old uncle, it's probably too late and you're going to be on the wrong side of this wave. If you're hearing about this early, you happen to get lucky, you're integrated within the world of venture where all of this technology is new and there's actually people that are fundamentally looking out for new waves and investing extremely early. Like, some people that we know have been investing in crypto since 2010. That makes more sense. So it really depends on the source. Unfortunately, and what we've seen in a lot of these waves and a lot of these cycles is these retail investors get in at the wrong times historically. But during COVID, a lot of people had a lot of time on their hands. They started buying stocks and, you had that GameStop effect where people were chasing companies that didn't make money, companies that were unprofitable because it was a joke, it was a meme, these, cryptocurrencies that had absolutely no value or utility. And it worked for a period of time and then it didn't. You have some economic issues, you have rising interest rates, it doesn't work, and a lot of these people end up getting wiped out. So unfortunately, retail investors historically haven't been doing a good job of that. Now, this time has been a little bit different. This year, retail investors bought the Liberation Day dip quite a bit. So that's a good sign. Maybe there's more sophistication and consistency there. But yeah, 9 times out of 10 from the last few market cycles that we've seen, people are buying high and selling low, unfortunately.
Yeah, that's right. It's like saying this time is different has not been a systematic way to invest, at least throughout the history of investing. So I would caution listeners to really believe, right? It's this time is different until it isn't, is generally the way things play out. Let's shift gears. So we've talked kind of about, okay, fads, what are they? What are some examples in the present day? What's the general or common denominator behind them? But why do they fail?
I think they fail because ultimately, at the end of the day, our system is a system. And if you buy something, the way that you make money is by selling it. And it's sort of like a pyramid scheme. Like, you can't continuously sell off at crazy valuations forever. So there is a point of time in which reality sinks in and someone is caught holding the bag.
Yep. That's with fads, to be clear. That is not with sophisticated, researched investing, right? That is not how we think about the world and trying to play fads and figure out who's left holding the bag. So to be very clear, I want to make sure that's stated. But yeah, you're right. There's a great adage that I like to think about, that in the short term, the market can be a voting machine. What we're talking about today, crypto, in some examples, meme stocks, et cetera, like those are little microcosms of that in extreme examples where momentum is actually an academically studied feature of markets in some cases, where there's kind of a lack or detachment from what we call fundamentals, right? Like what's the underlying business actually doing? Because when you're investing, if you're buying stocks, you're buying a piece of that company. When you're buying a piece of that company, you're buying a piece of the revenue or a piece of the profits or a right to the profits, your share of the profits of that business. If those fundamentals are not there or they're not growing, then what is your interest? What is that investment actually worth? And at some point, you go from a voting machine to a weighing machine, like where a weighing machine has physical properties. And we don't know when that actually takes hold, right? In times like this, where there's a little bit of a detachment from reality. And we're not necessarily saying we're back in the dot-com era, although there's some metrics that kind of can go back to that and point to the disconnect between prices and actual economic fundamentals are pretty wide. But we don't know what that tipping point is going to be. And so having that process and staying disciplined and paying attention to long-term fundamentals and understanding like, hey, we might not be with the herd today, but that's okay because we're in this game of staying wealthy over the long term. I think that's a great reminder as well. And also know with a diversified portfolio, you're actually benefiting from the herd mentality. You're just doing it in a much more disciplined way.
And I actually want to hit on your point about staying wealthy. Most of our clients are already wealthy or are on the trajectory of becoming wealthy. You don't need to create this. You don't need to hit the lottery twice. Very hard to do. So that is the mindset that you need to be operating in. All right, you've already won the lottery. You're a world-class athlete. You don't need to buy $100,000 of Pepe coin and hope that it 1,000x's because, your career could do that as is. And it's exactly what you said. It's the game of staying wealthy. And that is very different from getting to that wealth in general. That preservation game is totally different. So on that note, switching gears a little bit, these fads are going to continue to come up. There's always going to be these new waves. How would you analyze them, review them, take in all of the information, and sort of systematically go through them via a checklist to figure out if this is a fad or maybe if it's a legitimate investment opportunity?
Yeah, sure. Of course, I have some notes ahead of time as we prepared, but just running through it real quickly does this complement or fill a part or a piece of a diversified portfolio? We were talking earlier today outside of this conversation that, hey, if we want to be diversified, the simple framework there is, okay, let's own the market. And so that's a question you could ask. Is this part of the market that actually or is this something that represents part of the market and therefore I want to own it? If the answer to that is yes, then okay, check that. Is there a repeatable methodology to this, or is this just a story? I mean, a great example, present day example is American Eagle. I'm sure a lot of people have heard about the Sydney Sweeney marketing campaign. That marketing campaign, whatever you think about it, added $200 million to American Eagle's market capitalization. Does American Eagle make better jeans now? And have they turned that into actual revenue? I don't think they have quite yet. Maybe they will because people are paying attention and we're talking about it and it will actually end up as revenue on the top line. But as it stands right now, that has not happened. And so right now, that is just a story. That is not long-term kind of repeatable process and value accretion to that business. Does the opportunity have sound financials and a clear path to profitability? This is kind of in the startup space, right? It's not just an idea. You're not just saying like your example of the Ponzi scheme, right? Can we just sell this to someone else because of the story at a higher price? What's the worst case scenario? And if you're adding this to your portfolio and it can go to zero, is that going to permanently impair your ability to meet your priorities? I mean, that is incredibly important. Do the people running the show have real experience and integrity? I mean, gosh, the integrity piece of it is incredibly important, right? A lot of these hype-involved or hype-induced opportunities end up being more than just, hey, this was an investment opportunity that went belly up. It's like there was some sort of grift here and borderline illegal behavior. Have you done the work or are you just following the crowd? That one I think is probably the most important here. Ask the questions, understand as much about the business as you possibly can, leave no stone unturned, talk to other clients, talk to customers, validate the idea. What potential traps can come up with this fad? Is this something that, you're going to end up facing a huge tax bill or the regulators are going to come clamping down on it? And then, as we kind of wrap here, does it help achieve long-term objectives? That's more than just, is this supporting a diversified portfolio? Is this actually helping increase your expected returns or build a more robust portfolio? And then how often will you kind of revert back and check to see if the points above actually still hold true? So you walk through this list, and there's probably more. This is just like a real simple framework we put together here. And if it doesn't pass most of these, it's probably worth just passing, moving on, and keeping your process in place for now.
I do want to actually touch on two of the points that you made around ethics and around also doing the work. We saw this with FTX. People were so excited about FTX and crypto in general that they decided to do none of the work and didn't look at the ethical side at all of the business or the partners and really the leadership and management. So it is so important to just slow down, take a step back, really evaluate what you're doing and evaluate investment opportunities for what they are, who they're actually being run by, and not just jumping on a train because you think that it's going to go somewhere cool. It is so, so important to be diligent here. And unfortunately, sometimes financial markets force you to not be diligent and move extremely fast. And history has shown us that it's better to be slow and potentially miss out than move too quickly and get wiped out.
Totally. And it goes back to what we talked about, this whole idea or mindset of staying rich, play the stay rich game. And that leads to process over hype chasing or FOMO. That leads to just a reminder that if something sounds too good to be true, it probably is. Yeah, maybe someone got lucky and got in before and made some money on it. That has happened, but that is not a repeatable process and way to ensure high probability, a high likelihood of keeping your wealth and even growing it for the multi-generations that come after you. So with that, we'll wrap today's show. Stay rational, stay researched. As we jotted down here, I really like that one. Maybe we'll adopt that as a formal tagline. Until next time, own your wealth, make an impact, and always be a pro. Thanks for listening.